Thank you. Dave Moore called me about 7 weeks ago and said, "Hey, would you just come and talk and tell the group, CCIM group, what you do and how you do and why you do it?" And I said, "Well, yeah, sure, I'd be happy to do that." And then about a week ago, he calls and said, "Well, you got to fill an hour and it's got to be an education thing." And I said, "Well, I don't know how much of an education this is going to be, but this is what you're going to get. So bear with me here." But my voice is a little hoarse. I've been yelling at my kids' activities the last 2 weeks. So, but anyways, thanks for having me. Scanlan Kemper Bard Companies has been around since 1993. I joined SKB in 1996. And Bob Scanlan and I have been, partners. I became a partner in 2002, and now Bob's still very active, but most of the investment decisions ride on my shoulders. So what I thought I'd do is just give you guys a quick overview of what SKB does, how we do it, why we do it. Maybe go through a few case studies. And then I know there's been a number of questions about our potential crowdfunding activity, and I wanted to briefly touch on that towards the end. So here we go. So this is our typical pitch book we give investors. So hopefully you guys can read this. But essentially, like I said, we've been around since '93. We focus on the Western United States, primarily office. In retail, some industrial, some retail, some hotel, but primarily office and retail. We are active investors. We like to work the real estate. I would say we tend to be focus on more of the value add or opportunistic side of the equation. Although recently we've landed an institutional investor out of Chile that is more passive in nature and wants more kind of core plus type opportunities. We, since the beginning, we've been able to achieve about a 10% return to our investors, and that's through good and through bad. From 1993 to 2008, that was 28%. We had our fair share of issues. During the downturn, post recession, we're around 26% on our realized opportunities. Oh, I should also mention that we also do bridge lending, kind of the $1 to $5 million range, and that can either be first mortgage loans or mezzanine loans. Primarily for developers, we'll make land loans. It's more in the hard money category than the key bank category, for lack of a better term. So here's the makeup of the management team. Bob Scanlan is still CEO. I'm president. We've been together for 19 years. Bob founded the firm 3 years before that. James Paul has been with us for 15 years. Rich Marine handles our capital markets group. Rich is out of Denver, and he was a former GE Capital alumni. Robert Riley runs our hotel group, and George Schreck is our CFO and Chief Compliance Officer. So on average, we've been together for 10 years, and our years of real estate experience is about 30. So this is kind of going back, and these numbers are current. So $3.5 billion in activity, $1.1 billion of equity invested, 25 million feet, 2,000 apartment units, and we, like I said, we actively manage it. We like to leverage our relationships for off-market opportunities. I think that's the biggest thing for us is we really pride ourselves on doing what we say we're going to do, and those relationships have allowed us to attract a number of the opportunities that we get to do. Here's some of our capital partners. Let me back up a second. Of the 1.14 billion in equity that we've raised, probably 800 million of that has been from high net worth investors. And then in 2000, with the recession, we realized that our high net worth investor base wasn't going to be where we thought it was going to be. So going forward, so we decided to start actively soliciting institutional partners. So from 2011 to today, we've been able to secure about $400 million of equity capital from the following institutional partners. AEW, some of these guys you'll know, some of the guys you won't. Washington Capital out of Seattle, Goldman Sachs, the Palladium Group, William Harris Investors is a family office out of Chicago. Garrison Investment Group is a money manager out of New York. Wyzetta is a money manager out of Minneapolis. Varde is also out of Minneapolis. InvestCorp invests money on behalf of investors, high net worth investors out of the Middle East. Prudential, Oak Tree Capital, and Independencia, that's our Chilean pension fund investor. As you can see, this is kind of gives you an idea of where our deal flow has been. Currently, we've been pretty active in California, Arizona, Denver, Utah, Portland, and Seattle. We've gotten into Florida and Texas and Missouri, but those are all, or Kansas, I guess that is. Those are all investments that were part of a portfolio from something else that we ended up acquiring. I'd say currently our active markets are Seattle, Portland, San Francisco Bay Area, Denver, and Phoenix. That's kind of where we're spending most of our time. And then, like I said, this isn't quite somehow this got screwed up, but we're the value enhancement strategies we look to. We like to buy B assets at A locations. We like to buy assets that are in positively transitioning neighborhoods. We like motivated sellers, underutilized properties, assets with changing land use, things that we can actively manage to lease up, and assets that we can reposition. Let's see if there's... And so what we're going to get into here is these are just a few of the assets that we've acquired from 2000 to 2015. We'll get into a few case studies here in a minute. I would say our biggest, we tend to look at a lot of different risk mitigation factors, but the biggest lesson that we learned this last time around, especially when you're buying assets that need are in some form of transition, is, and for the most part, most of the assets that we buy are reliant on jobs. You need job growth for people to demand the assets that we own. So when there isn't any job growth and there's no demand for office or retail space or industrial space, people are going back, downsizing. The biggest thing that we learned was leverage. Was either going to be, it was our friend when things were going great, and it was our enemy when things weren't going great. Pre-recession, I would say our leverage levels were in the 70% range, 68 to 70% range. Post-recession, we're in the 60 to 62% range. And I would say that between 2008 and 2010, there was a lot of, we didn't acquire anything during that time frame. We just hunkered down and tried to manage the portfolio. And the single largest debate that we had is if we put more money into these assets, are we going to get at least that money back. And it was the single largest hot debate issue in the firm, along with our investors. And in hindsight, there were probably 3 or 4 assets that we probably should have put money into that we didn't, and we ended up giving back to lenders. So from our perspective, the single biggest thing that we've learned this time around is leverage, and being a little bit more moderate in our leverage. Because the incremental discussions that we were having were, well, if we put another 5 or 10% equity in this thing, or 15% equity in it, are we going to be able to get that back? And it turns out, in most cases, we would have. But it was just on the edge. The valuation adjustments were just on the edge of being underwater or overwater relative to your current equity. And so it just didn't, when people were scared, they'd rather do nothing than make an active leap of faith. So from our perspective, leverage was our big thing. The other area that we've decided from a risk mitigation standpoint going forward, last cycle we spent a lot of time, we were executing the same business plan. Initially it was in urban markets, and then as the markets got more frothy, we went to secondary and tertiary markets, trying to earn the same type of yields, doing repositioning lease-up plans for assets that were not in as high quality or sustainable markets as we were looking at earlier in the cycle. And so this time around, what we have elected to do is stay in those primary markets and live with a lower yield and a lower return, and just deal with the market. And really kind of put a lot of time and energy into a particular submarket versus chasing yield to secondary and tertiary markets. Our current portfolio is currently about 5.4 million feet. At our high water mark, we were about 8 million feet. You can see here it's roughly 25% mixed use, 50% office, 7% retail, 14% industrial and/or flex. And then up top there's a geographic location where we are today. So this is really too bad that this is not working the way I thought it was. So anyways, I'll just go through a couple of these case studies. The one down here at the bottom is Sunset Tower. This is in Hollywood. We bought this asset in 2005. At the time, Hollywood was didn't have the press or the cachet that it does now, in terms of it had kind of fallen off by the wayside. This building is where Larry King was broadcasting. It was about 80% leased. It was a pretty tired building. It was about 2 blocks off of Sunset and Vine, which had just finished a kind of a major mixed-use project, residential and retail development. But the rest of Hollywood was still pretty tattered. You know, it's right next to West LA, and West LA was on fire, but Hollywood still had its kind of issues at that time. And so I looked at the Sunset and Vine location, which were 2 blocks away. I realized that those retail rents that they were getting there for brand new construction was in the $35 to $40 a foot range, triple net. We were getting $20, $18 to $20 gross on the ground floor of our building. And with all the office market doing what it was doing on the west side, I just thought, you know, it's coming our way. And the asset had a huge parking garage behind it. There happened to be 3 or 4 nightclubs in the neighborhood that were very, very popular nightclubs. And nobody was using the garage at night. there was 5 guys working in the garage doing, you know, the valet system. And so when we bought the asset, we decided, well, let's go ahead and modernize the garage with current equipment. Let's cut deals with these nightclubs to lease our spaces at night. Let's execute a plan to redo the ground floor from office uses to retail uses, and modernize the elevators and do a full-blown lobby remodel. We owned the asset for about 15 months. We really got things going. The market started, people recognized that the market was coming our way. We took occupancy from 80% to middle 90s. Office rents when we acquired the property were in the $21 gross range. We ended up, the last deal I think we signed was in the $30 range. And so it was and then we liquidated the asset 18 months later for what we thought we would sell it for 10 years down the road. And so it was the multiple business components that made up the deal. It just wasn't one strategy. And I think that's the other thing that we really like to focus on is if you're relying on one strategy, then you're really you could be setting yourself up for failure. If you get kind of multiple touch points on what you can do to add value, that's kind of where we think we provide the secret sauce, so to speak. Well, this one's here so on the last one, so you can just see the top of it there. We put $11 million of equity in that deal, sold it 2 years later, 2.5 times everybody's money back. So this case study was CH2M Hill Center here in Portland. This was owned by Oregon Pacific. Randy Lavray and Julie Lovery. They had decided that they wanted to diversify out of their office buildings and get more into the dive further into the residential business. They were facing CH2M Hill having their lease, which is about 65% of the building, was coming up in 36 months. They didn't want to go through the pain of doing that lease renewal with them. So they elected to sell the asset before that lease renewal. So we acquired the asset in late 2012. It was we had made an offer on the property. There was another buyer that was a higher bidder. They went down the road with the higher bidder, and that bidder didn't pan out. They let us tie the property up. And we were very transparent with them about how we were going to fund the capital. We had a couple of capital partners that got on the phone with them, said they were very interested, wanted to invest in the project. And then when it came time to releasing contingencies, they left us at the altar. And we went back to Randy and Julie and said, hey, here's where we are, here's what we're doing about it. Your call. You want us to stay in the transaction or not stay in the transaction? And at that time, they elected to stick it out with us. We went through 3 capital partners. But it was our transparency and honesty about exactly where we were in the process that got them comfortable that we were doing everything that we could do to get the transaction done. So we elected to, so the game plan was renew CH2M Hill, remodel and upgrade the asset, and then liquidate the property. We decided the only way we're going to get CH2M Hill to renew on terms that we wanted them to is to start spending money. And so we went ahead and spent $2 million remodeling the lobby. And that kind of got their attention that we were serious, and there was a new sheriff in town, and we were prepared to spend spend money on the asset. Through those efforts, we ended up doing a blend and extend with them. We renewed them about a year early. They downsized, they gave up a floor, and we got a fresh 10-year lease out of them. And all the while, we DEQ, which was the second largest tenant in the property, decided they wanted to consolidate their offices and vacate. And so we had the lobby remodel done. We had CH2M Hill renewed. We were all thinking we were great, and then DEQ decides to leave. That was a good news and bad news in that the market had fully recovered, and everybody, you know, you've seen all the headlines relative to sales happening here in town, and how healthy the office market is. And so what we were able to do is, because we had gotten a LEED EB Gold building, we had redone the lobby, we had renewed CH2M Hill, we found a buyer that wanted to take advantage of the leasing momentum in town and effectively paid us for the vacancy. So we had the asset. Yeah, here it is at the top. We had the asset for just over 3 years. We put $17.5 million of equity into it and earned 1.8 times our money back. So that, you know, so that kind of gives you an idea of what we do. There's a few other case studies here. I'll talk. Here's one in. Here's another one here in Portland, Jansen Park, now the Hannah Anderson building, and this is kind of an asset that we perceived as one that was in a positively transitioning neighborhood. This asset was converted to an office building in the middle 90s, and at one point it was the North American headquarters for Adidas. And it had become an REO with one of the CMBS loan servicing companies. We got wind that they might be considering a sale, and they took an offer from another local investor. They found some environmental issues and elected not to close. And so we stepped in. We decided that this neighborhood, given what's going on in downtown, given what's going on the close-in east side, this neighborhood's going to benefit from all of that. We thought it would take a little longer than it did, but so we ended up closing the asset. I think we ended up paying about $80 a foot for the building. We decided to put about $2.5 million into completely redoing the building. Redid all the windows, the lobbies, fire life safety systems, HVAC, completely turned it into a Class A creative building. Before we had announced our plans, but we had really not started a whole lot of work yet. Hannah Anderson showed up. Hannah Anderson was in the Pearl District. They were in 5 floors, very inefficient, you know, 9,500 foot floor plates. And they really needed it. They were out of space. They needed to grow. They didn't want to pay the freight in the Pearl. They still wanted creative space. And so we ended up signing Hannah Anderson to a long-term 10-year lease for about 2/3 of the property here. And this is going to hit the market later this year. And we're hopeful that we'll make, you know, probably 3 times our money on this one. This was just market. We executed to a T on the business plan, but it was the market has really bailed us. You know, has really kind of supercharged our efforts. So let's see. I'll do one more case study here in town. Coin Tower. This was an off-market transaction. The guy who runs our property management group lives in Seattle. was at a Kidder Matthews function in Seattle. He was talking to a couple of the brokers, and a couple of brokers happened to be from San Francisco that were Kidder Matthews guys from San Francisco up for this function. They started talking about this asset that one of their clients has in Portland, and he called me the next morning or that night and said, "Hey, you know, what do you think about this coin tower thing?" Or, you know, and I said, well, we got to get on this. So I wrote an offer. The moment from the time I got the phone call to the time there was an offer in this guy's his hands was about 6 hours. And because you know, at the time we just thought, from a price per foot perspective, we really knew what was happening and what was going on, and we, at $250 a foot for one of the most iconic and visible buildings in town, that was going to work. And I didn't know how or why or what, but I just knew that it felt right. So this was one of the first times that we actually had a bidding war with our institutional partners wanting to do the deal with us. So we were able to extract pretty attractive economic terms out of our capital partners. And the game plan here is, look, everybody recognizes the building from the skyline. It feels a little sleepy right now, and it still feels like it lives in 1983 with the pink marble and everything in the lobbies. And so the intent here is to take advantage of the office market, bring the asset back to its full potential. I don't know if you guys know how many of you have been to the building recently, but we have Charles Schwab in the ground floor, and we're going to vacate Charles Schwab and capture Charles Schwab space as part of our lobby. And it'll be about a $4.2 million remodel we're going to do given it's Coin Tower, we're partnering with Coin, and we're going to do a huge media wall on one of the walls in the lobby. So it should be a pretty unique to Portland. So in the next 60 days, you'll see that announcement. Parties are the final results aren't in on that one yet. But again, it was an off-market deal, and we had to act quickly. We did. And then once the seller knew that he was kind of, he heard the pricing on, let's see, one main place, is it called? And versus our pricing, and realized he had left a little money on the table, so he held us accountable to our closing, and we fortunately Prudential closed. We closed all cash and then put financing on after the fact. So that's kind of, there's my mug, there's Bob, James. So that's kind of SKB in a nutshell. The other thing I was asked to talk about, given the press that we've had relative to our, is some of our crowdfunding efforts. And so what we, historically, as I mentioned early on, we had, most of our capital came from high net worth investors. And at one point we had over 800 high net worth investors that invested with us. And we have our own broker dealer. And the way it used to be before the crowdfunding phenomenon, you had to have a quote-unquote pre-existing relationship with an investor to take their money. You couldn't just say, hey, here's the deal, give me your money, and we'll go. You had to kind of qualify them, preview them, make sure everything was good, and quote-unquote, in our definition of a pre-existing relationship is know or correspond with that investor for a period of 45 days prior to taking any money from them. And at that, with that broker dealer, we had a sales force of about 12 people, and we, At our peak, we were finding investors probably, we were getting investors that quote unquote fill out an AIQ, which is investor questionnaire that qualifies their ability to invest with it. You know, makes them allows us to verify that they're accredited or qualified investors. And at our peak, we were getting about you know, one investor per week with that profile. And then with the Jobs Act, you know, which I'm sure most of you guys have heard about already, but the Jobs Act really allowed, in 2012, allowed for direct solicitation of investors. So that 45-day period and your ability to advertise went away. You still have to qualify people. You still have to, you know, make sure they do what they are who they say they are. But in terms of getting to know somebody, that requirement is now gone, and so which is now allowed for advertising, and that's been the real impetus driver for this crowdfunding phenomenon that you're hearing about. According to the Zeman Center of Real Estate at UCLA, by 2025, all crowdfunding platforms, including real estate, should be about a $90 billion industry. The first half of 2015, all crowdfunding platforms, including real estate, has been about $5 billion. In real estate for this year, they're expected to be about people are expected to raise about $2.5 billion of capital for crowdfunding, through crowdfunding efforts. So that's the good news. So I think it's a deep market. It's going to get deeper, and from our perspective, it's a market that we're definitely going to play in. Some of our concerns and things that we're going to do differently, I'm going to touch on here. Right now, it appears that the top 4 or 5 guys that are raising capital in the real estate business for developers, they're raising that capital typically in $1 to $1.5 million tranches, and the average investor is putting in about $70,000. So it's, for all these huge numbers that everybody's talking about, on a specific deal, it's still not a lot of money per deal. And so, and that compares to our average historical high net worth investor per deal was investing between $200,000 and $250,000. So, and what we've kind of seen with this, with the current players out there, and no disrespect to anybody that's in there, in the space right now, but it seems to be the theme for all of these folks is, for the way I characterize it, it's the McDonaldization of deal flow. How fast can I turn an opportunity? People are focused on, if you look at the websites, there are guys sitting on their couch being able to do a couple clicks and they can make an investment in 30 minutes or 15 minutes, or, well, we still believe that there's somebody behind that screen that you have to be accountable to. And so for us, it's not so much how fast somebody can actually make an investment, but make sure that we're selling our trust and our experience, and making sure that the investor that wants to invest in our opportunities, that they have the wherewithal, and this is the right investment for them. And so we are coming out with a crowdfunding platform. We're not changing. It's going to be part of the SKB website. It's not going to be a separate entity. And it's going to be catered towards our pre-existing, the profile of investor that we currently have worked with for the past 20 years, which in all likelihood is an investor that has investable assets of at least $5 million. So it's, I think we're going to go about it a little differently than what, how the rest of the quote-unquote crowd is doing. It's not going to have crowd in its name. It's like I said, it's just going to be an offering. You're going to be able to see and review SKB offerings on our website where you couldn't see them before. Yeah, so that's how we're attacking it. We've been spending about 18 months on this. We had a pretty stout back office to communicate with all these investors once an investor was a part of an SKB investment. We really didn't have a vehicle or a platform to communicate with investors that didn't know who we were, or existing investors that wanted to invest in new opportunities other than just email. And so we've kind of going through a full-blown rebranding. So the website is going to change in the next 90 to 120 days. And with that will be a portal that you can review and see SKB opportunities. So it's a little different tact than most of the guys have taken on today. Initially, we're going to offer our own investments. And there may be a point in time where we offer investments for other sponsors, but they'll have to go through the same rigor that we make ourselves go through for our own offerings. So that's our take on crowdfunding for what it's worth. So I'll open it up for questions at this point. Yeah, Connie.
On your crowdfunding portal, for lack of a better word, because it's really not a portal where a whole bunch of different people put projects in. You guys are doing this privately, which is, I think, is a great idea. Are you going to reduce your minimum offering offerings through that internet site? And are you going to continue using your broker-dealer to do evaluation of the investors and the suitability? Because you don't have to, and so I don't know, I'm curious whether you're going to keep that process going.
We are going to keep the broker-dealer, and our minimum investment now is $50,000, even though the average was $200 to $250,000. So I think we will keep the minimum of $50,000. What we're not going to do, and a lot of these Fundrise, we're not going to take any unaccredited investors. We're not going to allow $1,000 increments or $10,000 increments from investors that are not accredited. So for the most part, every investor that invests with us will have need investable assets of at least $5 million. Any other questions? No, we're not doing it. We're not doing it. No, we have we have registered on Fundrise, and we're like one of 360 sponsors that are on Fundrise. We have not put an offering on Fundrise. Actually, I take that back. We did an offering about a year and a half ago on Fundrise just to kind of test this out, and we got it funded. It turns out we decided not to move forward on the transaction, but we got it funded, and our the low water mark was, some guys wanted to put in $10,000–$15,000. We told them no. And the high water, we had an investor that wanted to put up $250,000, so that was the high water mark. And for us, that was kind of the proof of concept. That, but at the same time, we've got all these institutional investors, and what we don't want to be perceived is catering, offering a Big Mac to Prudential. It's just not. Not the deal. So we needed to come up with a formula that allowed us to solicit our high net worth investors, but also instill trust with our institutional partners that everybody's interests are aligned.
Yep. Blend the investors together, the crowdfund and the institutional guys in the same asset?
We will. We will. And along with our own money. So, yes.
You mentioned that you have some foreign or sovereign capital as an investor partner. Do you find that you're competing with those dollars now post-recession, more foreign capital coming in, or was it a better climate before recession?
Well, I think given we've kind of moved to working with institutional partners, our average deal size has increased. You know, our average deal size post or pre-recession was probably in the $25 to $40 million range. Our average deal size now is in the $75 million range, and so I would say that we didn't bump into the international investors as much as we do now, and so I don't know if that's the deal size or it's just because there's more foreign investment coming into the market. I would say that, Independencia, for example, who we own the American Bank building with here in town, they have been in the United States for the past 25 years. They've only elected, as was with this cycle, to come to the West Coast. They've been primarily an East Coast investor. So we have seen a lot more. In general, I would say that foreign capital is coming into the market at a much quicker pace than, that's my perception anyways, than the last cycle. So, any other questions? Okay, thank you guys. Oh.